Nvidia investors found themselves staring at one of the strangest market moments in recent memory. On the surface, the company released news that should have sent the stock sharply higher. Instead, Nvidia's share price slipped by roughly 0.1%, a tiny move, yes, but deeply puzzling. When news looks overwhelmingly bullish, why would the stock move in the opposite direction? That contradiction is exactly what makes this story so important. In this video, the goal is to unpack the announcement in full detail, explain what it truly means for Nvidia shareholders, and quantify the potential financial impact step by step. This includes breaking down how this development could affect Nvidia's revenue, profit margins, free cash flow, and ultimately the company's intrinsic value. To do that properly, the discounted cash flow valuation model is revisited and reassessed to determine how much Nvidia could really be worth if this opportunity turns into reality. The catalyst behind all of this came from a Reuters report. According to the report, Nvidia is experiencing exceptionally strong demand from Chinese technology companies for its H200 artificial intelligence chips. The demand is so intense that Nvidia has already contacted its manufacturing partner, Taiwan Semiconductor Manufacturing Company, asking them to increase production capacity. The numbers are striking. Chinese technology firms have placed orders for more than 2 million H200 chips, while Nvidia currently has only about 700,000 units sitting in inventory. To understand why this matters so much, it's critical to zoom out and look at the bigger picture. For years, Nvidia has been effectively locked out of the Chinese market for its most advanced technology. The United States government imposed strict restrictions, citing geopolitical and national security concerns. Nvidia was only allowed to sell much older, far less powerful H20 chips to Chinese customers. Those chips failed to attract interest, and Chinese authorities reportedly discouraged domestic companies from buying them altogether. As a result, Nvidia's sales to China collapsed and became almost non-existent. That's what makes this next development so dramatic. The US government approved Nvidia's sale of H200 chips to Chinese customers, a decision that fundamentally changes the playing field. This approval reopens a market that had been shut for years, but approval alone wasn't enough. The critical unknown was whether Chinese companies would actually want these chips. The Reuters report answers that question clearly. Demand is not just present, it is massive. For Nvidia shareholders, this is an extremely positive signal, and it makes the muted stock price reaction even harder to explain. There is, however, a major condition attached. The US government requires Nvidia to hand over 25% of the revenue generated from these chip sales to China. That requirement functions like a heavy tax on sales. At the same time, while two major hurdles have now been cleared, US government approval and strong customer demand, one final obstacle remains unresolved. The Chinese government has not yet confirmed whether it will allow these transactions to proceed. That uncertainty is the key reason investors are holding back and why Nvidia's stock hasn't surged on this news. Let's talk numbers. Market estimates indicate that Nvidia plans to sell a specific version of the H200 chip priced at approximately $27,000 per unit. With orders totaling 2 million chips, that translates into roughly $54 billion in total sales. This figure closely matches earlier statements from Nvidia CEO Jensen Huang, who previously suggested that gaining access to the Chinese market could unlock around $50 billion in annualized revenue for the company. From that $54 billion, Nvidia would be required to pay approximately $13.5 billion to the US government under the 25% revenue requirement. After that payment, Nvidia would retain about $40.5 billion in net revenue. Now let's examine profitability. Nvidia's gross margin has recently stabilized around 75%. While the company's newest Blackwell platform initially pressured margins during its ramp-up phase, margins have since recovered. Earlier periods saw margins closer to 70%. but those levels are now behind us. The H200 chips being sold to China are based on older, mature technology. That means lower production costs, a well understood manufacturing process, and minimal learning curve issues. All of that suggests margins could be higher than Nvidia's corporate average. However, to remain conservative, the analysis assumes a 75% gross margin. Applying that margin to $40.5 billion net revenue results in more than $30 billion in gross profit. Operating expenses are then estimated at roughly 15% of gross profit, or about $4.5 billion. This assumption aligns closely with Nvidia's historical margin structure, where the gap between gross margin and operating margin has typically been around 15 percentage points. Nvidia's operating margins have exceeded 60% in recent periods, reinforcing the credibility of this estimate. After subtracting operating expenses, Nvidia would be left with an estimated $25 to $26 billion in free cash flow from these Chinese sales in just 1 year. That is an extraordinary number. To put that into perspective, Nvidia generated approximately $131 billion in total revenue over the most recent 12-month period. A $54 billion contribution would represent roughly 40% of that total. While this level of demand may reflect pent-up purchases after years of restricted access, it still demonstrates the sheer scale of the opportunity. Even when compared against projected future revenue of about $200 billion, these sales would still account for roughly 25% of Nvidia's total revenue. The impact on operating margins could be even more powerful. This is mature technology. There is no need for heavy new research and development spending. Nvidia already has 700,000 units in inventory and would only need to manufacture an additional 1.3 million chips to fulfill the reported orders. That combination creates exceptionally strong incremental profitability. When these cash flows are fed into a discounted cash flow valuation model, the implications become very clear. Nvidia's current intrinsic value is estimated at approximately $119 per share without factoring in this opportunity. Adding an incremental $25 billion in free cash flow dramatically changes the picture. If these sales are approved and sustained, that incremental cash flow represents roughly a 25% boost to Nvidia's baseline free cash flow projections. Under those assumptions, Nvidia's intrinsic value per share increases by approximately 20% to 30%, pushing fair value into a range of roughly $250 to $280 per share. Yet despite this upside, the market remains cautious. Investors are not fully convinced that the Chinese government will grant final approval, especially given the ongoing geopolitical tension between the United States and China. Yes, the US government has approved the sales. Yes, Chinese companies clearly want the chips, but Wall Street is waiting for the last piece of the puzzle. If Chinese authorities officially approve these transactions, the stock's reaction could be much stronger, potentially jumping between 5% and 10%. Even then, investors may stay guarded, knowing that trade tensions could flare up again and disrupt sales in the future. The full 20% to 30% valuation upside assumes smooth, uninterrupted sales, an assumption that carries real geopolitical risk. Adding another layer to the story, Nvidia is currently covered by 66 analysts. Among them, 59 rate the stock as a buy, 6 rate it as a hold, and only 1 has a sell rating. The highest price target for the next 12 months stands at 432.78, while the lowest is 138, both extremes that appear unrealistic. The median price target sits at $250, which is far more reasonable and achievable. Importantly, these price targets do not include any positive impact from Nvidia selling H200 chips to China. Even without factoring in China, Nvidia already represents roughly a 35% upside opportunity based on the median target. If Nvidia successfully executes these sales, the upside could exceed 35% over the next 12 months. Right now, this opportunity remains a catalyst, not a guarantee. The projected cash flows are intentionally excluded from the valuation model because the outcome is still speculative. But if approval is granted and sales move forward as estimated, Nvidia's valuation could be revised sharply higher. In summary, while uncertainty remains, the potential approval of H200 chip sales to China stands out as one of the most powerful upside drivers Nvidia has on the table today. If realized, it could fundamentally reshape Nvidia's revenue growth, profitability, free cash flow generation, and intrinsic value. My objective is to present investors with analysis grounded in data and facts, not hype or flashy predictions, so you can make informed decisions. This approach is built on years of valuation experience and supported by formal education, including both a bachelor's and a master's degree in finance and investment. This content is not financial advice. Happy investing.